In 1988, I bought Coca-Cola stock. I have never sold a single share. That was 36 years ago. The world has changed almost beyond recognition since then. Governments have fallen. Technologies have transformed entire industries. Markets have crashed and recovered multiple times. Companies that seemed invincible in 1988 no longer exist. Coca-Cola still exists, and my position is worth many times what I paid for it. People ask me constantly, when will you sell? What price would make you sell? What event would trigger a sale? My honest answer is, I cannot think of one. Not because I am sentimental about the stock, not because I am stubborn or inflexible, but because I understand something about holding that most investors never fully grasp, something that goes far beyond the simple advice to buy and hold. Today I want to explain exactly why I hold the stocks I hold, for as long as I hold them, why my favorite holding period is forever, and why the decision to sell, a decision most investors make far too easily and far too often, is one of the most expensive habits in personal finance. Let me start with something fundamental. When I buy a stock, I am not buying a ticker symbol. I am not buying a line on a chart. I am not making a bet on what a price will do over the next 6 months. I am buying a piece of a business, a real business with real employees, real products, real customers, and real earnings. A business that existed before I bought it and will exist after I sell it, or after I choose not to sell it. This distinction between a stock as a price and a stock as a business is the most important conceptual shift in all of investing, and most investors never fully make it. When you think of a stock as a price, you are always focused on the wrong thing. You watch the number go up and feel pleased. You watch it go down and feel anxious. You make decisions based on what the price has done recently and what you think it might do next. You are essentially speculating, guessing at the psychology of other market participants, rather than evaluating the actual value of what you own. When you think of a stock as a business, everything changes. The daily price movements become largely irrelevant. What matters is whether the business is generating more value over time, whether its competitive position is strengthening or weakening, whether the management is allocating capital wisely, whether in 10 years this business is likely to be larger and more profitable than it is today. I bought Coca-Cola in 1988, not because I thought the price would go up next year. I bought it because I believed, after careful study, that Coca-Cola was a business that would still be selling its products to billions of people decades into the future, that its brand was strong enough to maintain pricing power, that its distribution system was so deeply embedded globally that it was nearly impossible to replicate, that the business would be earning more in 2010 and 2020 and 2030 than it was in 1988. I was right, and the returns have reflected that. But here is the crucial thing. I could only be right if I held. If I sold in 1992 when the price seemed high, or in 1998 when a different opportunity looked attractive, I would have captured a fraction of the return that patience produced. Most investors dramatically underestimate the cost of selling. They think about it as a simple transaction. The price is here, I sell, I take my profit, I move on to the next thing. Clean, efficient, rational. But there are 3 costs to selling that almost never appear in that calculation. The first is taxes. When you sell a stock at a profit, you owe tax on that gain. In many jurisdictions, this can be 20, 25, even 30% of your profit gone to the government the moment you sell. That is capital you can no longer compound. And the longer you would have held, the more devastating the compounding effect of that missing capital becomes. The investor who holds for 30 years and pays tax once, at the end keeps far more of their return than the investor who sells and reinvests every few years, paying tax each time. The mathematics of this, when you run the numbers, is often startling. The second cost is reinvestment risk. When you sell one thing, you face the immediate challenge of finding something equally good or better to buy. This sounds straightforward. It is not. Wonderful businesses at fair prices are not always available. The market is not constantly offering you attractive entry points into excellent companies. And if you sell your wonderful business and cannot find something equally wonderful to replace it with, which is often the case, you are either holding cash waiting for an opportunity or settling for something less good. Either way, you are worse off than if you had simply held what you had. The third cost is the loss of compounding momentum. Every time you sell a business, even at a profit, you reset the compounding clock. You take the gains, pay the tax, and start again from a lower base. You interrupt the snowball. The investor who holds the same wonderful business for 30 years lets the compounding accumulate without interruption. The investor who buys and sells every few years repeatedly resets, paying tax, facing reinvestment challenges, and losing the exponential growth that only uninterrupted compounding produces. I have said for decades that my favorite holding period is forever. This is not romantic, it is mathematical. Not every business is worth holding forever. In fact, most are not. Let me tell you what I look for when I am deciding whether something deserves a permanent place in a portfolio. The first characteristic is a durable competitive advantage, what I call a wide moat. A moat is anything that protects a business from competition over long periods of time. Pricing power, brand loyalty so deep that customers would not consider switching. Network effects where the product becomes more valuable as more people use it. Cost structures that competitors cannot replicate. Switching costs that make it expensive and inconvenient for customers to go elsewhere. Coca-Cola has one of the widest moats I have ever encountered. The brand is embedded in global culture in a way that no competitor could replicate with any amount of money or time. People do not just buy Coca-Cola because they are thirsty. They buy it because of what the brand means, a feeling, a memory, a consistency that has been built over more than 100 years. American Express has a moat built on prestige and trust. Geico has a moat built on cost efficiency. See's Candies has a moat built on the emotional significance of the product to its customers. People buy it as a gift, not just as candy, and the brand association makes them willing to pay a premium. These moats, when they are genuinely wide and genuinely durable, make a business worth holding through market cycles, through economic downturns, through periods when the price falls and the headlines are unkind. The second characteristic is honest and capable management. A wonderful business with mediocre management will eventually disappoint. I have seen this happen. I would rather own a wonderful business managed by honest, capable people who think like long-term owners than a slightly more wonderful business managed by people who are focused on the short term. The third characteristic is predictability. I want to be able to look at a business and say with reasonable confidence, in 10 years, this business will still be doing essentially what it is doing today, and it will be doing it more profitably. Businesses with this kind of predictability, consumer staples, well-established financial brands, businesses with deeply embedded customer relationships are the ones worth holding forever. Businesses that are exciting today because they are disrupting something, but whose competitive position in 10 years is genuinely uncertain, are not the ones I want to hold forever. They may be worth owning, but they require closer attention and a different kind of patience. I said my favorite holding period is forever. But that does not mean I never sell. There are three situations in which I will sell a business I own. The first is when the fundamentals of the business change materially and permanently. If a business I own loses its competitive advantage, if the moat is breached, if the business model is disrupted in a way that cannot be recovered from, that is a reason to sell. Not because the price has fallen, because the business itself is worth less than it was. This requires clear-eyed, honest analysis. It is easy to confuse a temporary difficulty with a permanent one. I have made that mistake myself, holding too long through deterioration that turned out to be fundamental rather than temporary. But the principle remains: sell when the business changes, not when the price changes. The second situation is when the price reaches a level that is genuinely far above any reasonable estimate of value. I am not a market timer. I do not sell businesses because I think the market is going to fall. But if a business I own reaches a price so far beyond its intrinsic value that the expected return over the next decade is essentially zero or negative, that is a rational reason to consider selling. This happens rarely with truly wonderful businesses because their value tends to grow over time. But it does happen, and when it does, I am willing to act. The third situation is when I have a genuinely better use for the capital. If selling one business to buy another, one that offers significantly better value and equally strong fundamentals, makes clear mathematical sense, I will do it. This is rare. Finding something clearly better is not easy, but it is not impossible. Outside of these three situations, my default is to hold. The burden of proof is always on selling, never on continuing to hold. Let me tell you what holding Coca-Cola for 36 years has actually produced, not to boast, but to make the principle concrete. I paid approximately $1,200,000,000 for my Coca-Cola position between 1988 and 1994. The dividends alone, received year after year, growing steadily as Coca-Cola increased its dividend every year, have returned a substantial portion of that original investment back to me in cash, without selling a single share. And the position itself, the shares I still hold, is worth many times the original purchase price. This is not stock-picking genius. I did not predict that Coca-Cola would perform exactly as it has. I simply identified a business with characteristics that made it likely to be worth more in 30 years than it was when I bought it. And then I had the patience to let 30 years pass. The returns from patience are not visible in the moment. They reveal themselves only over time. And this is precisely why most investors do not capture them. Because the waiting is uncomfortable, because the short-term fluctuations are distracting, and because the financial media constantly provides reasons to do something different. I have ignored those reasons for 36 years. And the Coca-Cola position is among the most satisfying investments I have ever made. Not because of any single clever decision, but because of the absence of unnecessary decisions over a very long period. Let me give you the practical version of everything I have just shared. If you are an ordinary investor, not managing a large portfolio, not evaluating individual businesses for a living, the principle of holding forever can be applied through index funds. A broad market index fund, one that tracks the S&P 500 or the total stock market, is a collection of hundreds of wonderful businesses. Not every business in the index is wonderful, but collectively, the index captures the strength of the best businesses in the American economy. When you buy an index fund and hold it for 30 years, you are doing something very similar to what I have done with Coca-Cola. You are buying ownership in real businesses, avoiding the tax drag of frequent selling, letting compounding work uninterrupted, and trusting that the collective value of those businesses will be higher in 30 years than it is today. The historical evidence for this is overwhelming. Every 30-year period in American stock market history has produced positive returns for the patient investor. Every single one, including periods that began just before major crashes. The key word is patient. You will see your index fund fall 20, 30, even 50% during market downturns. The question is not whether this will happen. It will. The question is whether you will sell when it does. If you sell, if you panic and move to cash at the bottom, you lock in losses and miss the recovery. If you hold, if you trust the underlying value of the businesses you own and let time do its work, you will, in all historical likelihood, be significantly wealthier in 30 years than you are today. The decision to hold is not passive. It is active. It requires daily, weekly, monthly decisions not to sell. Decisions that go against instinct during downturns, against the advice of television commentators during panics, against the temptation to do something when doing nothing is clearly the right answer. I have made that decision with Coca-Cola for 36 years. You can make it with whatever you own, starting today. I bought Coca-Cola in 1988, and I have never sold a single share. Not because I forgot I owned it, not because I was too lazy to sell, but because every time I evaluated the decision clearly, every time I asked whether selling made mathematical and strategic sense, the answer was no. The business is still wonderful. The moat is still wide. The management still allocates capital responsibly. And the dividends still arrive, year after year, growing steadily, representing a return on my original investment that has long since exceeded what I paid. That is what forever looks like in practice. Not a romantic notion, not stubbornness, a clear-eyed, continuously renewed decision to hold something wonderful, because nothing about the business has given me a compelling reason to do otherwise. Most investors will never experience this kind of return, not because the opportunity is unavailable to them, but because they will sell before they reach it. Do not be the investor who sells the tree before it produces fruit. The fruit takes time. It always takes time. But it is real, and it is abundant, and it belongs to those who wait. If today's video gave you a different way of thinking about holding versus selling, please subscribe to this channel. Every week I share one clear idea about money, grounded in 60 years of watching what works and what destroys returns. Leave a comment and tell me, what is the longest you have ever held an investment? I want to know, and I read every one. Patience is the strategy. Holding is the discipline.